Please welcome Apttus Vice President of Strategic Shared Services, Fady Stephanos, and partner at Bain & Company, Simon Heap.
Good morning. So Fady and I are here to talk to you some more about the concept of revenue yield from the business side and why it can be so valuable for you to address the opportunities that are there. So what do we mean by the term revenue yield? There is a cycle in business that starts with the order-to-cash process for any given deal, and then goes on to the overall customer life cycle over the life cycle of a customer. It starts with being able to configure the best deal that you can, then to be able to price it and get the maximum price realization for that deal, to contract for it and get the best terms and conditions, and ultimately compliance on those terms and conditions, and then to bill for it, and then ultimately to be able to get customers who are on service contracts to renew or just simply buy again. So this is happening in your current business, and the problem with this is that over time, revenue can leak from this process. There's revenue leakage. Why is that? Well, you don't get the best deal on the table. You discount too much. You don't have the right terms and conditions. Customers don't comply. You actually don't bill what you booked. Customers don't renew. This is all leakage that can happen in your business. In an area that I'm most familiar with, which is the enterprise software industry, if you add up all those pennies that fall out of the revenue cycle, that can actually add up to as much as 15 percentage points. Said another way, that's like only getting 85 cents on every dollar that you deserve. Now, by definition, because it's in your business today, that revenue that's leaking out, you've already invested the product investment, you've already invested the go-to-market, and so at some point, the profitability of doing that is actually quite high if you actually capture that lost revenue. And so in most businesses, that's quite valuable. The chart here begins to set up the idea that in business, there's an inherent trade-off between profitability and revenue. If you want to grow, you invest in product, you invest in sales and marketing. That takes money. As growth begins to decline, then you need to become more efficient. In the software industry, which I work in most of the time, the data looks like this. This is real software companies plotted on this chart. And if you're below this line, there's something called the rule of 40, where the sum of the growth rate and the profitability should be, for a well-performing software company, 40 percentage points. If you're below this line, you could be in trouble. You could end up, if you're in the bottom left, with activist investors showing up in your stock. And so there's two ways, potentially, you might think of doing better from a performance point of view. Well, one, you could try and reignite growth. Everyone wants to try and do that. But that's quite hard, and actually takes time. Secondly, you could cut cost, but that's no fun. What the taking action on revenue yield does enables you to actually move up and to the right in these terms, delivering both growth, which could be several percentage points, and profitability at several percentage points as well. So if that doesn't convince you that there's some value in addressing these opportunities, consider this, which is some data for all companies. It's for 3,000 companies over 10 years. And what it's showing is the difference between total shareholder returns. So total shareholder returns is stock price appreciation, dividend payback, et cetera, in terms of whether companies on the horizontal axis are just growing profits, or they're growing profits and revenue at the same time. And you can see the difference in the top right-hand corner of delivering profitable growth delivers far higher shareholder return than otherwise. So, how might you actually go and achieve some of these things? At the highest level, it's as you might expect. How do you actually go and pick up some of that 15 cents on the dollar that might be leaking out of your processes? It would be around configuring the best offer. It would be around controlling discounting in the field. It would be around putting in place terms and conditions that actually define things like minimums and time to revenue, and then ensuring there's enforcement of compliance with those contracts. It would actually be billing what you've booked. Don't forget to bill the second year of a multi-year contract, for example. And finally, for customers on service contracts, being able to diagnose the root causes of defection, raise retention rates, and actually try and get uplift on the price you get for retention, and expand the footprint of what you're selling. So that, at a high level, is the concept of revenue yield. I'm going to hand it over to Fady, who will describe in more detail some of the opportunities and challenges he's learned about working at Apttus.
Okay. Thank you, Simon. So as I was getting ready to give a keynote and a little talk about revenue yield, I was speaking to a mentor of mine to just get some tips. And he said, one of the things that you should do is you should start off with some sort of interesting fact that's going to hook the people in, hook the audience in. And one of the facts he did tell me was within 30 seconds, 35% of the audience has already decided they don't like the speaker. So with that, I'm not sure if I either need if his point was just jump right into the topic, or was it that I need a new mentor? So with that, I'll actually just jump into two things I'm going to do with you today. The first is going to be around defining the revenue process and the concept of revenue yield. The second thing that I'm going to do is, as we step through this process, I'm going to highlight all the challenges, some of the business levers, and the results that you can expect to achieve by optimizing revenue yield as you go through the process. So the very first step, when you think about the middle office, Kirk described what you see from the front office and what you see in the back office. And the middle office is connecting the two. It's essentially taking a customer's intent to purchase, which starts in the front office, and connects it all the way to the exchange of goods and services and monies, which happens in the back office. Those two, sometimes called the quote-to-cash process, resides in the middle office, and it's your key revenue-generating engine. And the concept of revenue yield, as it pertains to that, is how much of that full potential economic value can you capture if you're doing all these things very optimized and making sure that every single point in this revenue process, you're maximizing your potential outcome. It starts off with what we call the configure step here. I think we call it configure on the slide, but it's actually a lot more than that. It actually starts by knowing your customer, understanding the requirements, understanding what it is that they're looking to purchase, and being able to design an appropriate solution that is pertinent and relevant to that customer to make sure that it's something that's going to help you win the deal. As an example, if you think about, say, an airline manufacturer that's out to bid for some airlines that are looking to buy aircraft. As an airline manufacturer, you need to understand whether that airline is running short-haul versus long-haul routes. Are they running a point-to-point or a hub-and-spoke model? Are they maybe shuttling vacationers to beach destinations, or are they running premium business passengers between two main business hubs? Is the aircraft that you're proposing to selling, is that compatible with their existing maintenance facilities or not? All these details in the requirements and gathering process dictate what sort of bundle and set of products you're going to go optimize and offer up to your customer. It's going to have an impact on the interior cabin configuration. It's going to have an impact on the airline, the aircraft itself, maybe the jet engines that you put on there. All of those details and much, much more are related to how you do the solution requirements gathering in this configure step. And to be able to do that effectively, you need an enabled sales team that understands your products. Your products need to be simplified. The catalog needs to be understood. You need to make sure that you have access to technical field teams that are going to help you through the solutioning process. One of the important things that I want to impress upon all of you is that the concept of revenue yield is cumulative, and it starts here in the very first step. If you sub-optimize what you offer to your customers at this one step, you've lowered the base of which you can build upon in every subsequent step, or you start with a lower base that's going to further erode in the subsequent steps. So cumulative effects start here, and you can see some of the results on the screen for what you can expect to achieve by doing this step properly. The next step is price. I think price is a very well understood concept. It's the amount that is requested for the value that is being delivered. And it's arguably one of the most important business levers available to any company when it comes to revenue yield. In fact, in one study, actually a study by Bain, Simon, they said that there is an 8% increase in operating profit for every 1% improvement in realized price. So think about that. A 1% improvement in price flows down to your bottom line, an 8% improvement in operating profit. So if that's not revenue yield, then what is? That's affecting both your top line and your bottom line. A very, very powerful driver. So how can you expect to achieve some of these results in the pricing step? One, you can have access to price and cost margin waterfalls at the time of quoting and pricing. You can also look at leveraging smart approvals and ensuring that you have proper discount control so that your sales ops deal desk is focused on high value add tasks. You can also look at processes and systems that allow you to have the appropriate promotions and rebates and be market-driven and compatible with market conditions and dynamic with market conditions at that point in time. And finally, this is one of the most promising areas for applied AI, where you can leverage intelligent pricing at the time of pricing for a customer so that you make sure that you're capturing that true customer's willingness to pay. And again, as you can see the results on the screen, by doing this appropriately and doing this right and optimized, you can see an uplift in both margins and the reduction in discounting. As we further move on in the revenue process, the next step that we see is around contracting. Now, a quick definition on contracting, it's the area where you have your obligations and agreements are negotiated and decided between two business entities. And all too often, there's a very negative perception about contracts. I hear a lot of salespeople say, this is where my sales deal goes to die when it goes to legal. And while the focus from legal is around mitigating risk and driving compliance, there's still an opportunity to drive revenue yield and think about what are the business outcomes you can achieve by driving effective contracting processes. So in addition to the primary drivers, which is risk and compliance, you can still look at contracting as a competitive advantage by being able to respond to customers quicker. And you do this through the streamlined contracts. You're using standardized terms and conditions. You're looking at smart clauses. You're using intelligent authoring. So there are a variety of methods within the contracting space that can help you be responsive and mitigate risk at the same time. And that's some of the indirect benefits to revenue yield. The direct benefit to revenue yield from contracting comes with negotiating favorable payment terms that help you optimize your working capital. Working capital doesn't show up on a deal-per-deal basis, but it will show up overall in a company's financials, and again, something that drives overall revenue yield. As we continue to step, we get into the billing and invoicing step, and this is arguably where the interlock between the middle office and the back office starts. This is where you have your ERP systems, your order management, invoicing, billing, revenue recognition. Historically, companies focus on the sale. Once you got the quote, once you have the contract signed, before the electronic ink is dry, there are celebrations, and we move on to the next set of sales pursuits. But at this point in time, for most companies, you haven't recognized a single dollar of revenue. Revenue is recognized when you begin to start taking orders and delivering against those orders in this phase of the revenue cycle. And there are a variety of reasons why you can experience yield loss in this billing and invoicing step. You can think about what you've quoted and what you've contracted. You have to make sure that that's ordered. What is ordered needs to be booked. What is booked needs to be billed. What's billed is invoiced, and whatever you invoice, you have to collect cash on that, and whatever you collect, you're recognizing revenue. In each of those steps, because of a variety of reasons, you can experience yield loss or optimize your eventual yield. And the reason this happens is because you have a variety of value chains, business models, charge types that introduce complexity into how you can recognize your revenue. In fact, there was another study by The Economist that said 80% of companies today are seeing a change in how their customers want to purchase and pay for their goods and services. And out of those companies, 50% are changing their pricing models as a result. So you can see this change in the way that customers want to go, whether it's consumption-based, subscription-based, a variety of different business models are coming out. And because of that, doing this appropriately can drive further yield, and you can see a lot of that comes from just accuracy in this process and reducing the leakage in bookings to billings. In the final step of the revenue process, this is where enduring customer relationships are built. Whether you're a perpetual revenue stream that you're trying to maintain, or you're maximizing customer lifetime value for your non-subscription-based customers. In fact, in another study, also by Bain, at least I'm not quoting a competitor's results, right? In this Bain study, they said that a 5% increase in customer retention can produce more than a 25% increase in profit. And the reason is very simply put. Acquiring new customers is a lot more expensive than retaining your existing customers. And because of that, this is another opportunity where you want to make sure you have enough resources and the processes and systems in place to ensure that you're capturing all of those renewals, you're negotiating and putting in auto-renewal clauses in your contract, so this goes back to the contract step, that you're making sure you're baking in uplift in your contract renewal time, and that you're also you have a view into the visibility of the assets and entitlements your customer has so that you can unlock some cross-sell, upsell opportunities at the time of renewal. If you tie it all together, there's a few takeaways I want to talk about when it comes to revenue yield. One is the concept that the effects are cumulative. As you see on the screen, whatever you build upon, whatever that starting base is, you can either go up or erode from there. And so the effects are cumulative. That's the first point. The second point is that you can use revenue yield to execute on your current flow of business. This doesn't require that you go out there and enter new markets, develop new products. We're not talking about M&A. These are not the long-term things that you would need. With your current flow of customers and your current flow of products, you can optimize and achieve revenue yield. In doing this, you can expect anywhere from a 7 to 25% increase in sales, which is the revenue portion, and a 5 to 15% increase in margin, which is the profitable portion. And as Simon rightly mentioned, profitable growth is the primary driver of enterprise value. And with that, I want to open it up to a bit of a Q&A with you, Simon, and we can talk about some of the examples around the space.
Let's do that.
OK. I do have some prepared questions, but before we get into that, maybe a little bit of introduction about you.
Yeah, I work for a business consulting firm called Bain & Company. I work mainly in the technology industry, so I don't know how many people in the audience are from the tech space. And what I've spent most of the last 10 or 15 years doing is working largely on business transformations. That's go-to-market stuff and product stuff, but increasingly this notion of the middle office as part of an overall business transformation is something that we're increasingly seeing as a big opportunity. OK, excellent.
Well, you have a very rich and storied career, Bain. I've been lucky actually to work on some of your projects there, and I can attest to seeing some of the challenges we see in the revenue process. What's your experience been with the middle office?
I would say it's actually been a growing realization of the amount of value in business that's locked up in the middle office. You know, I think it comes from, I think, where Kirk was starting from this morning, the relative undevelopedness of the middle office compared to with other parts of the business, and the complexity that's locked up in there that just causes inefficiency and ineffectiveness. And so when you begin to dig into it as a set of point projects, like working on price discounting or like working on billing leakage, you can begin to see the value, but to be able to actually then string it all together as one big transformation actually is where the real breakthroughs can come from.
You know, one of the things that maybe I experienced, and tell me if you would agree with this, is that when revenue or growth comes too easy, you end up not building all the processes and the good hygiene that you need, and you may end up with suboptimal revenue processes.
That's exactly right. I think two things cause this, right? If you've been in a fast-growing company, you tend to go for the growth first and sort of put off to another day the cleanup of process and systems and so on and so forth. And then it's massively exacerbated by serial M&A. So as businesses grow, you'll maybe do tuck-in acquisitions. You might actually do major acquisitions. All of those require integration. Not all of those. I bet many of you in the audience have kind of lived through these situations where those integrations don't really happen until the next thing happens, and you're left with this sort of trail of complexity behind you, and that one day that catches up with you.
Yeah, it's as our CEO always likes to say, complexity doesn't scale, and so we do look for simplicity there.
Right.
So the realm of strategy consulting is all about M&A or post-merger integrations, or you're tackling new questions like where to play, how to win, so true strategy questions. How does all of that fit into the enterprise value you drive out of, say, consulting projects within the middle office?
Yeah, well, you touched on a couple of things there. So if you just step back and you're trying to improve the value of a business, of course, you're going to work on strategy, where to play, how to win. You'd work on product stuff. You'd work on go-to-market, the go-to-market strategy. All of those things take time, right? I mean, it takes 2 or 3 years to evolve a product strategy. It can take well over a year to change your approach to go-to-market and implement a different coverage model, for example. To be able to go after some of the things that we're talking about here, you can actually get started pretty quickly.
Okay.
Maybe not with big systems transformations, of course, but to just begin to get the disciplines and the process focus that begins to attack unnecessary discounting in the sales force just by deal desk, for example, and then beginning to understand just within the current systems environment where all those breakage points are, and beginning to knock off which ones you can address today, and begin to get some quick hit results from that. That, in turn, will begin to fund, or at least get results on the board that can set up a bigger transformation.
Okay, so you're starting to touch upon some of the symptoms or artifacts you would see that imply a middle office transformation is required. Can you elaborate a little bit on that, and how can the audience understand or recognize that there's an opportunity to maximize or optimize revenue yield?
Right, right. Well, hopefully you have metrics in the business that talk about each of the steps around that revenue cycle. And if you don't have metrics, then you've probably got an opportunity.
Okay.
What is not measured doesn't get managed. And so you could look at those metrics. But beyond that, there may be certain symptoms that you would see. So for example, discounting that you can't explain, high variability in discounting, which is not structural. You might see salespeople complaining more about the middle office than spending time with their customers. You might see enormous numbers of order management clerks sitting in cubes with screens with yellow Post-its all over them, trying to remember how to construct an order or an invoice, or renewals clerks trying to manually assemble a renewal quote. I mean, if any of those things are happening in a business, it's probably some indication, right, that there's inefficiency and ineffectiveness going on there, which the metrics, if you had them, would tell you as well.
So how would you measure the end-to-end process? Because what we've seen there are a variety of functions that touch upon that, and you can maybe measure rogue discounting or measure bookings to billings, but how would you measure the end-to-end revenue process?
Yeah, ideally, and if you were able to do a diagnostic of all of this, you would try and convert each of those point metrics, which are kind of process-specific metrics, into essentially a dollar number. So the ultimate currency is the dollar or the pound, or the euro. And that, in a sense, can actually give you a quantification of revenue leakage. And then there's other metrics that you might systematically apply to the whole process as well, around the amount of straight-through processing. Okay. Like how many orders from the point at which at least you quote it are going straight through without human intervention, in some sort of fast lane, and then how many are being peeled off for greater levels of inspection and exception. Okay.
Can you give an example where you've done some consulting or projects within the middle office, and what were some of those results?
Yeah, I worked a lot with these software companies who are rife with this type of problem, actually. So we worked with one large enterprise software company where the CFO, it was at the beginning of the financial year, and he was looking at the budget for the year and realized that there was actually probably quite a lot of risk in the numbers for the year. And also at the same time, we were looking at this and we saw a lot of the symptoms that I just alluded to in the sort of general middle office space. And what we decided to do was actually put in place a program around trying to do a series of these things together. And when I say a program, it really meant two things. One, that you actually had a program management office. Why? Because you need to manage all the interdependencies of that and actually sort of elevate it as a program in the sense where you can get breakthrough on these things and manage quite a lot of cross-functionality. Secondly, it was a CFO-sponsored effort. Why? Because it requires, the middle office, it's not something that's necessarily in the C-suite conversation, but the value is there. And so to elevate it and to actually sort of break down barriers where the functions aren't really working with each other and to deal with things like funding projects that require a little bit more investment, required that type of sponsorship. So we did that. The types of initiatives that were in there were a big effort on price discount control, a big effort on compliance to terms and conditions, and the third big leg of it was a renewals effort, knocking down root causes of non-renewal, et cetera. Total results in the year were, if I recall correctly, about 8.5% increase in bookings, and that flowed through to revenue and all the way down to 3.5–4% of operating profit. And that actually ended up being the difference between making guidance and not making guidance that year, and actually enabled them to be investing off the P&L into some other longer-term projects that they needed for the business.
So very, very material.
Oh, absolutely.
Okay, excellent. So how can we, as businesses, all prepare for a middle office transformation to begin capturing that type of value?
Yeah, I mean, as I'm saying, I think there's a number of things. I mean, one, you need sponsorship at the right level. I do tend to think that the CFO is a good natural sponsor of this type of effort. I think that programmatically managing it is important. I think there's some important precursors as well. We mentioned complexity earlier. So the extent to which you can simplify the business ahead of trying to especially implement big process change in systems is really important. And when I say simplification, we're talking about the number of SKUs that are in the business, the number of price lists, the number of buying programs, the number of legal entities that you have, all these different dimensions of a business that impose complexity on the back office and the middle office.
Okay, but that's starting to get into maybe more fundamental product strategy. When you think about product catalog simplification or just overall product strategy, surely that doesn't, I mean, maybe two questions. At what point do you know you've reduced complexity enough, but two, surely this doesn't stop you from embarking on a middle office transformation? Yeah,
so to answer the second question first, I mean, no, it doesn't stop you embarking on a middle office transformation to have to do a bunch of complexity reduction first, but it certainly will make a difference to how far you can get in that. You'll begin to hit some natural barriers. To think about how much complexity you can take out of a business, there's always a trade-off, right, or a tension in the business between, let's say, sales and marketing saying how many products and SKUs and offers you need to serve every different single segment of the market versus the cost of complexity, which is rarely really well understood. And so what tends to happen is the balance of those two things is invariably out of kilter. And so being able to think through, well, what dimensions of the business can we begin to simplify? Do we really need all those SKUs and offers? And begin to think about where the big breakpoints in what cost that implies on the business. If you begin to tackle some of that, that'll make a big difference in the long run of what a middle office transformation can get to. Okay. And how about funding the middle office transformation? Some of the concepts of revenue yield could be self-funding, but a broader middle office transformation, where do the funds come for something like that? Yeah, well, I think a full middle office transformation, if you're going to do the full vision of systems, is going to be a multi-year effort. It hopefully would start with a number of quick hits that actually demonstrate the value of that. Okay. And that, is, as you said, I think begins to self-fund it. Whether you can bootstrap it completely is probably a stretch. Okay. But certainly the quick hits in year to prove the value of this and get some momentum is important. Okay. And your answer essentially implies there's some phasing in value as you go through this journey. Can you talk a little bit about that? Yes. I think, I mean, if you were to think about trying to set up a transformation, I think there's almost a phase 0, right, which is getting the right sponsorship, deciding who's going to run this to elevate it in the right way. I think there may or may not be a diagnostic phase to this to kind of prove to yourself that there is value there, and where in that whole cycle of the dozens of root causes of leakage at the end of the day are the big ones to focus on and to focus on first. And then you're into sort of the sort of design and implementation phase. And that comes in waves and phases like any project. Quick hits first, systems requirements, systems transformation, et cetera, et cetera. And in parallel, probably at that point, beginning to work out where those complexity reduction efforts can come.
Okay. And earlier today, we saw a number of more full potential type vision of what a middle office can look like. And we saw technologies around Watson, so leveraging AI.
Yeah.
We also saw some examples of implicitly or indirectly, we heard about robotic process automation, RPA. You can think about blockchain for contracts.
Yeah.
So a number of emerging technologies in the middle office. Where do you see all of these technologies with a full potential view of the middle office and true revenue yield there?
Yeah, I mean, I think there's no doubting it that all those technologies are going to be super important to actually achieving the full value. In the middle office, I think automation, RPA, is going to be incredibly important to get that sort of flow through, the straight-through processing, is it called. I think the application of artificial intelligence is an interesting one, right? Which is you need to be able to focus any AI enablement onto the points in the process where decisions actually make a real difference. So pointing it at the biggest value sources.
Okay.
And so, I mean, typically you see that in things like dynamic discount control, looking at thousands of prior deals, seeing what makes sense, what doesn't make sense by way of discount, and feeding that straight back into the quotes.
Okay.
That's happening today, I think, and so on and so forth. So those technologies, for sure, are important. I wouldn't lose sight of the fact that at the end of the day, it's a business process as well. And so the types of discipline and process management and sort of exception management that's required are important too.
Okay, excellent. And I think that about wraps it up. I mean, maybe one last question for you. Actually, when I was a consultant, I heard a joke. They said consultants steal your watch and tell you the time. Mm-hmm. And do you know any good jokes about management consultants?
I don't know any jokes about management consultants.
Okay, all right. Well, thank you for your time, Simon. I'm glad you were able to make it out to Accelerate, and I hope you enjoyed the show.
Thank you very much.
All right, thank you.
Hope you enjoyed it.